Hello, welcome to the week ahead with me, Chris Pollock. Let's have a look at what's unfolded over the weekend. I look back probably to non-farm payroll figures on Friday and the unusual moves we had around 3 o'clock, which are certainly worth thinking about. And then looking forward to what's coming up this week. Powell, CPI, few earnings. As always, keeping eyes on what the big man Donald Trump is up to too, because likely to get some confirmations about further tariffs this week. So let's start with maybe what he told us over the weekend. This an announcement on Air Force One that a 25% tariff for steel and aluminium imports is likely to come into play. This also lines us up from what he told us last week that he's looking to announce reciprocal tariffs on Tuesday or Wednesday, or confirm those at least. He did suggest this to us on Friday. That anyone who is applying tariffs to them will have the tariffs thrown right back at them by the US of A. So tariff talk continues. Loads of volatility in the markets. 3 days last week, we had huge volatility on Trump news. On Monday, when Mexico last week announced that they were getting their tariffs delayed a month, having kind of come to some of the border controls that the US were looking for. That moved the markets. He then gave the oil market a little shakedown on Tuesday last week, where we had this big spike up on the news that Iran was likely to be undergoing maximum pressure from the US. We had a move of over $2.50 on crude up to those value area highs on the volume profile. That's why I'm called this, because these volume profile levels are incredibly important. And then on Friday, we had another shakedown in the late afternoon. This one in here, just after 3 o'clock, another move as we announced that reciprocal tariffs are likely to come through for anyone tariffing the United States. So 3 days last week, some big volatility on tariffs, and likely to see some more over the next few days, weeks, and months, you would anticipate. More gaps over the weekend. So if we kind of get rid of this a little bit, you'll see the kind of gap open that we had from the close on Friday down to where we opened, around 6,000 on the SPX, 6,015 on the ES futures, but that gap was closed even quicker than they have been in recent weeks. Right, we had this closed at the end of January, which took until the Monday afternoon or Monday evening to kind of get closed. The previous week with the Nvidia one, this gap took till the Friday to close, but these gaps are going to be all over the place. I've said this before, I'll say it again. Please be aware of whether it's wise to hold positions over weekend. Unless you have incredibly wide stops, you are running some pretty significant risk over the weekend, unless you know what he's going to say. And who knows? If you even know what he's going to say from one day to the next, then maybe being flat at the weekend might be a smart place to be. Let's zoom in on Friday, right? We want to talk a little bit about the economic calendar for the week ahead. But before we do that, I think there's something really interesting to take away from Friday's numbers. The non-farm payrolls are the biggest volatility event in US data history. And this one was an interesting one. So the headline figure, the non-farm employment change, was lower than expected, right? 143,000 jobs created versus 169 expected. Okay, about 25K lower than we thought. However, in the 20, 30 seconds after that news came through, we had a revision for the previous month. So that's for December, boosted up by over 50,000 jobs. Okay, so net, we were actually up 25,000 jobs relative to what we expected. No revisions on the unemployment rate or the average hourly earnings, but look at the unemployment rate back to 4%. They did change the rules a little bit on the unemployment rate. So this maybe confused things somewhat. But there's nothing confusing about this. The average hourly earnings, the wage component, was much higher than the market had forecast. When did we last have a 0.5? I think it's been a little while since we had a 0.5 on this. Yeah, we had a 0.6 back in Feb of 2024. But apart from that, this was the biggest print we've seen in some time on the wage component. So this measures basically how much wages are rising by. And wages are deemed to be like a sticky part of inflation. They go up and they do not come down in the way that things like oil prices can go up, but can also come down. Wages go up and stay up. It's very rare that you would accept a pay rise from your employer 1 month and then they come to the next month and say, hey, do you want a pay cut? You tell them where to go. Well, wages go up, stay up, unlike commodity price inflation, which can be inflationary and then deflationary incredibly quickly. And this is an interesting barometer of kind of medium-term inflation. If wages continue to climb at higher than forecasted rates, it normally filters into the economy as more money starts to float around. This ultimately causes more inflation. It's certainly something that will be interesting if these tariffs do go ahead. That is also going to be an inflation shock for the next 12 to 18 months, you would expect, before those base effects unwind a year after the tariff come into play. So what would we expect from this then? Hotter inflation, effectively hotter jobs, albeit mainly from the revisions, and the unemployment rate down. So this should be dollar positive. Good news has been bad news for the stock market. And yet, this is what I found incredibly interesting on Friday. We had the figure come out, and it was a bit of a crapshoot, right? We had this real uncertainty at 130, like a horrible candle. If you're trying to get long, trying to get short on these very quickly after the market, you're probably not doing very well. Trying to ride the momentum on this one. Maybe people got taken out on both sides, but the market started to take this news quite nicely. It was a surprise to me. Normally, this good news is bad news. Higher jobs, certainly the previous month when we had higher jobs than forecast, stock market sold off because of this likelihood of higher inflation and higher interest rates to come with it. But yet we rallied until the open, and then we rallied on the open. And then there was more data. We had the University of Michigan consumer sentiment. Not the biggest number you'll ever see. In terms of volatility, it's not that high on our list. Yet, as that figure came out, the market dropped 30 points in 5 minutes. Was this because of the non-farm payrolls figures? The University of Michigan figures? I don't think so. I believe this was pent-up selling that was likely to happen. They were just squeezing out any short positions that were trying to run anything post non-farm payrolls, and maybe these big positions just decided we're going to wait for this number at 3, and then we're just going to hit this when the book is thin. And lo and behold, it ended up being quite the decline, and then this was the Trump move lower as well later on that day. But yeah, 2 big hits to the market, and this was very, very strange at 3 o'clock on Friday. So if you look at what happened to gold at 3 o'clock on Friday, not a great deal, right? Look at what happened with cable, pound against the dollar at 3 o'clock on Friday. Not a great deal. So this doesn't look like it was something related to interest rate decisions, because quite frankly, the dollar didn't move. Yet stock markets had an absolute washout. So yeah, looking just at the S&P, 30 points off in a very, very short space of time. So really unusual action. To me, this was all not because of University of Michigan, but just pent up selling that was likely to happen given the strong data. The market was just squeezing the life out of those weak short positions, clearing the book before getting that move done. Those of you who are interested in kind of learning to trade this stuff, we do have some interesting areas to look at when we're trading, and these gamma levels, these option data levels are incredibly valuable if you want to learn how to use these. Look at where that high was when we rallied up. What the reason why we hit this 6100 on the S&P was this is the large gamma level where all the call positions were. Look at where we stopped and look at where we ended up on the way down to this gamma level. This is where I took my profits. Yeah, incredible how well this works. So if you want to learn about this, please feel free to reach out. We can do some one-to-ones around getting these on your charts, giving you some good guys. Really helpful. If you trade the S&P, I think you have to be using these zero data expiry option gamma levels. Even if you trade the NASDAQ, the patterns are incredibly similar. Those companies that are in both the S&P and NASDAQ, this would be incredibly useful. But yeah, let's get again into this. Got our profits here. Nice day on Friday. That's enough of looking back on last week. You're only as good as your next trade, right? Not your last one. This Monday is not looking like being too busy, right? So I'm recording this Monday morning because we knew it was going to be a quiet day today. The Monday after non-farm payrolls is often a pretty quiet day in terms of news flow, and this one is no exception. We do have Lagarde on the wires at an ECB annual report at the European Parliament, so we'll be hearing from her from 2 o'clock today. So Euro pairs, DAX funds, you might want to be tuning in to what she has to say this afternoon. Overnight, Japan's closed. But tomorrow afternoon, we get a couple more central bankers on the wires, right? Tuesday's giving us Bailey, and with the rate cuts that we had, which were very interesting last week in the UK, we kind of lean back on this. We were expecting a rate cut in the UK from the Bank of England, which we got, but we weren't expecting everyone to want to cut. We were expecting one potential hold from Catherine May. However, everyone wanted to cut rates. And in fact, of these 9 members who all voted to cut rates, 2 of them voted to cut it by 50 basis points. This was much more dovish than the market had been forecasting. I'm really curious to hear from Bailey this week. Could easily see some unwinding of the pound, but it has, to be fair to it, managed to cling on quite nicely since that initial flush on the news last week. Where was the... Here we go. So we kind of, see that move. We're not too far away from before the rate decision on Thursday. See where we go from here, but I think the cable could be a really interesting trading over the course of this week. Because we also have the Powell on the wires as well. The Powell, the powerhouse, is back on Tuesday. The man who moves the market more than any other until Trump is back, at least. Certainly in a Joe Biden presidency, this guy was the most important man in finance. Yeah, perhaps that's changed over the last month. But he's due to do his 2 semi-annual reports, one to the House, one to the Senate, one on Tuesday and one again on Wednesday. And this Wednesday one follows on from CPI, the inflation metric, the number that the markets have been caring about a lot. But the Trump tariffs aren't in yet. So how much we can read into these numbers being interesting, I'm not sure we can, but nevertheless, it is a big volatility driver. So if these numbers are higher than forecast, perhaps that would really get things moving if Trump comes through with his tariffs and gets them going. That would probably push this number up. You would expect year-on-year figures. We've got targets of 2%, right, for major Western central banks, already up at 2.9 year-on-year. You look back to his first presidency when he came in, inflation was pretty low, right, and he still crept up to that over 2% level then. Now he's starting from a much higher base. If his tariffs do cause inflation, we're not going to be looking at 2.9% inflation. We're looking at 3.9. So I think we'll get something around or close to 5% if these tariffs do go through this year. So really interested if this read remains high anyway. That initial base could be quite high for these tariffs. The Fed members, while they're on the wires as well, Thursday. I'm away actually this week, so I'm not too fussed about what's going on later on in the week. For those of you who are around, GDP in the UK, 7 a.m. Okay, PPI, I don't really care for this number too much when it comes out after CPI. And then retail sales on Friday. It's not the biggest week in terms of news, certainly compared to last week. So the data isn't really there for us. One thing that is interesting to me today is the earnings. We've got McDonald's earnings out today. This could be the most interesting thing today. For the Dow Jones, it's out at 7 a.m. Eastern time, which is 12 midday UK time. And Dow Jones is a pretty large, McDonald's is a pretty large proportion of the Dow Jones. Where are we sitting here? Around 4% of the index. So any big moves on this stock at midday, you will see this on the Dow Jones. So if you are trading US indices or certainly the Dow around midday today, please be aware of this news and you can capture it. If you want to learn how, again, please reach out for some one-to-ones. And then finally, there are a few other earnings due out. I think we kicked a couple down the road a little bit in here. So if we look at the Home Depot was expected out, but it's now been pushed back to the 25th, I believe. But we do expect Siemens, one of the biggest companies in the DAX, to report on Thursday of this week, along with Unilever as well, a big proportion of the FTSE. So some decent European earnings, but not a heavy week in terms of earnings. There's a bit more going on next week and the week after. Stocks like Home Depot, even bigger than McDonald's on the Dow Jones. This could really move the market on the 25th. So that's 15 days on. And then finally, bond markets. Is there much going on in the bonds this week? Let's have a look. I've not even checked yet myself. It'll be interesting to me and you. Best place for this, for free at least, investing.com do a really good bond auction calendar. So just pop it on bonds, click apply. Oh, didn't fancy it. Let's try again. And then to look at the week ahead. Do we have any big ones out? Yes, we do. The US 10-year I think these are going to be so interesting given what we now know about Trump and his tariffs, how the yields in the US are starting to creep up. Or 4.5 and taken on Friday briefly. In fact, we've been above 4.5 on the US 10-year again this morning. This is a quite an important line in the sand. We saw this on Friday, and it's kind of just keeps banging its head against this. These round numbers are really, really important for the market. You sustain above this, that could be interesting, and certainly the auction on Wednesday will be a big one to know whether these yields need to climb higher in order to get the demand in or not. So yeah, looking at this on Wednesday this week, this is 1 o'clock Eastern, I'm guessing. So normally these are 6 p.m. UK time. And we've got another 30-year bond. This one links closely to the US housing market. These two are pretty important. And yeah, the 10-year, though, I think is probably the most important auction of the week. Might even be more important than CPI with where we are with Trump. So, bit on the earnings. Probably not the busiest day on this Monday. Apart from that, CPI numbers will be interesting. Powell's on the wires. Bailey, Lagarde. It's very much a central banker heavy week. Not too much in terms of big numbers, but yeah, CPI, retail sales. I'll be away in the sunshine, ignoring those retail sales numbers. So, yeah, have a lovely week. Trade smart out there. Don't go too mad this Monday. Patient. There will be opportunities coming along. And make sure you've got a good news feed, because if you don't, then it's going to be very difficult to follow what is happening with Trump. And if you want to kind of join our Squawk list, we have links to a lot of these companies who post live news out incredibly quickly for free. Again, I can show you as well. Be very helpful this year.